Still underneath it. Decent.
Is it?
That's 5 right there.
Yes.
And then if 5 along the wall, that's 10. 15, and we're at 50 before we get.
Yeah, you're right.
What?
You're correct.
Sure.
Let's get that. Or not. Okay. What you.
Yeah. Meredith, thank you for having us. She would be mortified.
Yes, she. Right.
We're not going to wait to the end for questions. Should there be any or comments, criticisms, whatever. I know we've been threatened by more than a handful of clients to heckle us. So y'all bring it on. If something pops in your head, raise your hand or yell it out. We'll do our best to address it. We're not really stricken to a real, well, we've got an order of slides, but we can talk about anything in any order. Doesn't have to be cash reserves. Bruce, sit down, please. Thank you. Appreciate your cooperation, but y'all know us. We're with Jackson Thornton I'm out of Montgomery. Sarah's out of Chattanooga. Any entity, any association specifically about cash reserves, in large part because we've heard more questions from y'all in the last year than we have in probably the 5 years prior. So it's on the top of y'all's minds from our experiences. So we're kind of just opening up the conversation. We have some thoughts, things that we've taken away from national conferences and serving on national committees around rates and finances. So how can y'all best handle the challenges that y'all have from a financial perspective, right? So that's kind of what we hope to talk about and hope to get some participation about. But that's really the big driver. Is it's been on y'all's minds So let's bring it out in a public way and see what we can't come up with as far as best practices and things that we're seeing good and bad.
Thank you, Jim. And wanted to just go over what we're going to talk about today. Overview and definitions. What is a cash reserve policy? What are we actually talking about here? What are the different types of reserves that you can consider? How much is enough? I mean, I can't tell you how many times we get that question. How much money should we have in the bank? It is, we work with a lot of utilities, and the range of the cash that is set aside is vast. So, there's some utilities that could operate for 4 years without ever taking in another bit of revenue. And we've got a utility in Mississippi that likes to operate on 1 day of cash. So what is the right amount? We'll talk that through. What are the different types of reserve policies there, and how do you go about developing one? And then really one of the things I love best about TAUD is it's just such an environment of sharing best practices and what works for one utility. And as Jim said, we're hoping to open up the conversation on that so that y'all can all start talking about it. We can share what we've learned, and together, all the utilities can develop what works best for them. So first of all, what are reserves? Reserves are simply, well, I don't know if I can take this out or not. Reserves are just simply funds that are set aside for a specific cash flow requirement, a need, a task you have, or a legal covenant. This offers you protection against anything that's unplanned or unavoidable. Um, or so there are a couple of different ways to think about reserves, but that's all it is. It's cash that's set aside for a specific reason. Go ahead.
Yeah.
It's you.
You're also watching our dress rehearsal, so this is good stuff. All right, so savings account mindset, and this is really just a corollary between personal finances or home finances and trying to compare that to running a utility. What does that look like? And really, it's kind of simple. I mean, I don't have 8 different savings accounts, but I'm saving for 8 different things in one account, right? I mean, I'd love to have 6 months of my mortgage in savings. I'd love to have some money set aside in case I need to, storm comes through, I need to put on a new roof and I don't have time to wait for insurance. For better or worse, my oldest son starts college in 2 weeks and they want to get their money. I've been saving for that for years to be able to pay for that. So how much should you have? Every situation is different, but there is a best situation for every utility in here. Some systems that have a robust or surplus amount. Why? Right? I mean, there needs to be a story behind whatever amount that you have. There needs to be a story behind it. Doesn't necessarily have to be a policy. It'd be great if it was. Policy is going to be really restrictive, typically. But how do you balance that versus rate pressure? What's a sufficient amount of savings that will allow for financial flexibility? Right? Because if something happens, you want to have the money there. Don, towards the end of his presentation, talked about, getting emergency permission or emergency bond funds, but then you pop up on T-Board's radar. Is it worth it? I don't know. I'd never heard about it until 20 minutes ago. I don't know. But there is a point where it is too much and hard to defend rate actions or rate increases, rate adjustments to bring in more revenue when you've got a theoretical surplus of funds that aren't earmarked for something specific in the very near future. Sarah?
And the other way to think about it is as an insurance policy. So you think about, the traditional savings account, and then you've got what risk are you trying to mitigate? So every utility out here has a risk of cybersecurity breach, of natural disaster, of an unplanned emergency main break, a failure of some system, whatever it might be. you have to be prepared for that. So it's kind of a balancing act of, how do we mitigate it? How do you mitigate your risk and have enough set aside so that you have enough operating reserves so that if you need them in an emergency situation, they're there. And then, it kind of correlates to why you have insurance on your house, why you have insurance on your car. You're going to have you're going to have insurance, but it may take a while for insurance to kick in. You need to have funds set aside so that you can, the thing about the industry that we're in is you have to provide service 24 hours a day, 7 days a week, 365 days a year. So an interruption in service is a big problem. So you want to have the resources available so that you can get your system back up and running if something goes wrong as quickly as possible. And oftentimes that's expensive. You're doing it on an emergency basis and you need cash right now. So I think, as we think about reserves, it's really kind of a combination of both of these. What is the balance? Your savings, what you're saving for, what risks you have out there, and then how do you balance that to make the best decisions for your utility?
And that's picking on Greenville. FEMA's coming, probably. We don't know when, but you've had to spend the money, right? And if you had sufficient cash reserves, and that's given the situation, it's an extreme situation, but you can't depend on the cavalry coming in when they're supposed to be there. So how much can you self-fund so that you're then paying yourself back when FEMA does finally get there with the check? As opposed to having to tap an emergency line of credit, have some level of cash there that serves as insurance or peace of mind, however you want to phrase it, right? And we did pirate this from an earlier presentation in Denver this summer. Reserves as insurance, in my mind, those are big projects. Those are big things coming down the line. That's big buckets of money, either big things coming down the line or exposure that you have on older assets. The reserves as savings, I'm kind of thinking that more along the lines of O&M. How much, do we want to have 6 months worth of O&M in reserve? Do we want to have 9 months? What's an appropriate amount? So it's really kind of the big bucket, and then the visual for the piggy bank. The more you have, and the more you have earmarked to specific things, specific causes or specific triggers, the more flexibility you have financially. And the more flexibility you have, the better off you're going to be. You're not going to be cornered into some extreme rate action or having to go to the emergency borrowing and then pop up on T-Bor's radar. You're going to have flexibility. You're going to have peace of mind. And where it comes into play in our world, specific to rate consulting, your rates are going to have to fund it. The cash isn't going to just appear, right? It needs to be an intentional action from management and the board. We are comfortable with X amount of days of operating of capital, and we'll get into each of these specifically now, I guess. But what's a safe amount? What's a secure amount? Where are we going to feel like we're making decisions from a proactive basis or viewpoint versus reactive? Reactive actions typically are more expensive than proactive. There's a cost to waiting. What does that look like relative to cash?
And I think as we think about that, there are a number of different types of reserves. So a lot of y'all have asked, well, how much should we have? There are different ways to look at it. And I think as a utility, you want to look at each of these areas, operating, that's just your day-to-day O&M. How much cash do you want to set aside? How many days of operating expenses do you want to have? And then capital projects, are you saving for one particular project, one particular capital program, so that you don't have to borrow as much over time? Kind of what what you identify as your needs relative to capital, and then you want to take repair and replace.
Sure. And that's, I mean, one thing, and Sarah's touched on it, the, don't tie it to a dollar amount. Tie it to days or months of need. Because if you think back, if you had a policy you wanted to have $500,000 of O&M expenses or $500,000 to cover O&M expenses, well, 5 years ago, that could have bought you 2 months, 3 months, whatever it might be, depending on the size of your system. Well, it's probably about half that now. So your policy, your goal is now half as effective today as it was 5 years ago in my little hypothetical. The repair and replace, you know, when we work from our standpoint as rate consultants and looking at cost of service studies, when we ask y'all for your capital work plan, what are y'all going to be doing in the next 3, 4, 5 years? A lot of times, especially with the first time client, the first bit of information we get are the big things. We're going to expand treatment plant capacity. We're going to run this mile of line. We're going to run this line out. We're going to do this. And it's the big stuff. It's the new stuff. Very rarely first time through we're setting aside X amount a year for rehab and replace of existing infrastructure. Very rarely is there, we're going to have, you know, we're buying 3 new trucks this year, 4 next year. That very rarely is the big stuff is always in there. The little stuff very rarely is initially. And it's an important part of what y'all need to do. That repair and replace isn't fun, but you've got to have it. And how much of that do you want? And there's not a right or wrong. Like, it'd be wrong if it's 0. It's, you know, you're going to have to do it. Why not start saving for it now and slowly increase rates in order to build that up instead of waiting until it happens and then have to borrow money or do the emergency line of credit or whatever it might be. Debt service is another one. And then after debt service,
Okay.
back to you. But with debt service, if you have 2 years worth of debt service on hand and you have to go to the bond market, you're going to look a lot better than if you only have 2 months that are earmarked. Doesn't have to be restricted necessarily, but earmarked for debt service. And one thing to keep in mind, if you do have a goal of 1 year of debt service, 2 years of debt service, when you're going to the bond market or SRF or whatever it might be, start planning to increase your rates enough so that you're now going to cover the new debt service at 1 year, 1.5 years, or whatever it might be. So it's a proactive, the more proactive you are, the better and more sound your financial plan can be, which again, all of this is rooted in financial flexibility.
Yes, and I'll touch on what Jim said relative to the debt service. If your bond covenant reads that you need to have a 1.2 coverage, that needs to be your minimum. You need to shoot for a little more than that because you don't know what's going to happen through the year. And that brings in emergency. So you want to have an emergency fund just like you do with your personal savings. If something unforeseen happens, and we all know it does, and you want to just be able to weather those type events without it impacting your financial viability. Also, special purpose reserves. So we've worked with a handful of y'all, quite a few of y'all, on capacity fees. That would be a special purpose reserve. So capacity fees are monies or revenues that you collect to expand your system, whether distribution system or adding capacity. So those funds, and we've talked to y'all, need to be earmarked to spend for those projects that are growth related, that you're going to invest in your system, whether you're increasing capacity on the distribution side or the treatment side. But those need to be set aside. That would be an example of the special funds. Rate stabilization reserves, that just means, you know, if you have a really wet summer and your revenues are down, you're not going to have to raise rates to cover that revenue that you've lost. So you ought to have enough cash in to smooth out the years that are bad years, or the year, you know, you ought to be socking money away on the years where it's drought conditions or, you know, very dry conditions and you're selling a ton of water. And ideally, y'all have heard us talk about this. Ideally, your rate structure has more fixed revenue built into it so that that's another way that you're mitigating the risk of weather. But you want to have enough cash so that you can smooth things out from a financial standpoint if the weather's not quote normal.
And I want to give one real world example around debt service. We're working with a municipal electric system down in Alabama, about an hour from Montgomery, my hometown. But they've been running gangbusters, and they built up enough surplus cash. They paid down $20 million of debt. But that took they were comfortable with where their cash reserves were. So we're meeting with the mayor Wednesday of next week, and we are incorporating. They figured that, their management team wants to get that $20 million back in their cash reserves over the next 5 years. So we are now targeting in their cost of service study, $4 million a year of additional cash reserves to build that cash reserves back up. That is always something to be mindful of. It is, and we've done it for a handful of y'all here in Tennessee. Having a cash reserve line item in your study relative to your revenue requirement or your target is important. It's becoming more important as there's more and more pressure on, basically your dollars are going, not going nearly as far now as they did 2 years ago, let alone 10. So how can we get the most out of our money, right? Without putting an undue burden on our customer base. All right, so this is me still, I think.
If you go ahead.
Or is it both?
It doesn't.
Go ahead.
No, I mean, and again, we've touched on it already. It's a balancing act, but part of what we've talked about with a lot of y'all is if you have whatever you have in the bank, whatever cash you're setting aside, know why you have it. So that is going through each of those categories that we just talked about and knowing, so that if somebody comes in and says, why do you have $5 million? Well, we set aside this much for debt service. We set this much aside for emergencies. You can say why, know why you're spending that, and just be able to balance that. Again, it is going to affect your rates because you're setting aside money that you're trying to build up and save.
Relative to kind of preparing for risk, the one thing that we've seen far too often is entities or utilities will delay capital projects because there's not enough money and I'll kick the can down the road to avoid a rate increase or avoid dipping into cash reserves too heavily. It's probably not going to get cheaper in 3 years or 2 years when you might reconsider doing it again. And this is where I continue my role as bad cop, I guess, but lack of cash is a hard justification to not do necessary projects. And we have seen that far too often. Luckily, not as much in Tennessee as we have seen it in Alabama, but it is the socioeconomic situation around the utility. You still have to provide safe, reliable service, right? And that costs money day in, day out, year in, year out. And not having cash on hand or not having sufficient rates ultimately is going to cost your ratepayers more in the years to come. It's never been more expensive than it is now, and it's probably going to be more expensive in a year than it is today. Cost of goods, cost of labor, interest expense, everything else.
And really, there's not a one size fits all. So it is you looking at what is appropriate for your utility. We do, Jim mentioned it, we do a lot of cost of service studies. The methodologies, the thought processes, all of those are very consistent. While y'all have the same job of providing safe, reliable service, each one of your systems is unique with its own set of characteristics and risk tolerance and environment and everything else. So what's right for one utility ain't gonna be right for another. So, but you need to kind of look at why you're doing it. Jim touched on it earlier. Don't tie it to a specific dollar amount. Tie it to a range. What are we shooting for, and monitor it.
And that's, along those lines, I think we kind of get to it on the next slide. So I might steal some of Sarah's thunder, but and I want to say this repeatedly, it does not have to be a policy. It does not have to be board governed. It can be a tool in the management team's toolbox. Is literally just a best practice or is a practice. It doesn't have to be a firm policy. It certainly can be. And if you do have a strongly worded cash reserve policy, then make sure there's some outs, if you will. Like
Flexibility.
flexibility and because picking on Laura in Greenville, there's no way that could have been foreseen. There's no way you wouldn't have dipped below your cash reserve policy. Well, what does that trigger, right? So there has to be some caveats. There has to be some qualifiers because you will, it based off just disastrous events, you can dip below that just trying to thread the needle or bridge the gap before FEMA comes in. And that's why to Sarah's point about a range, I would love for y'all, instead of targeting a 1.25 debt service coverage, target 1.5. I'm an Auburn football fan. Hugh Freeze needs to go 8-4, or he probably won't be there next year. I hope he isn't planning to go 8-4. I hope he wants to go 12-0. And theoretically more than that, but I'm also realistic. So don't target the minimum. Don't target legal covenants. That's baseline. That is the bare minimum, right?
And that, you can keep going on that.
No, you
Randy,
can
if you- Okay. So when you're thinking about this, there are some guidelines out there. So reached out to the comptroller's office. They have this great budget manual that I had really never read, but it's a good resource. I know y'all are probably all aware of it, but they have some guidelines relative to that. Cash is a percent of cash expenditures. You need to be greater than 15% as to what you have set aside. Percent of liabilities needs to be greater than 1.25. That debt service coverage ratio greater than 1.2. This is the floor. Okay, so that's the bare minimums. GFOAA has a great guideline relative to cash reserves for enterprise funds. AWWA, and we've shared it with a lot of y'all about, it's probably been 6 or 7 years ago. The committees that Jim and I both serve on wrote a white paper for cash reserves, and it goes into a lot more detail of what we've been talking about today. So different considerations around operating reserves, all the different types of reserves, but there are resources out there. You're not starting from scratch. So keep that in mind and use what's available to you.
No, and I will say the white paper has a lot of good, a lot of California in it. So a grain of salt for a lot of us here, but it has great case studies on what other utilities are doing and a little bit of the why, right? And it's good at a minimum. We are rate nerds and utility finance nerds, but it is a good read. And I'm embarrassed I said that in public, but it is a good read. There's a lot of value to it. And it can at least continue this conversation, get y'all thinking more along the lines of what it needs to be, what's best for y'all. What's just looking at Cody, what's best for HPNTS is going to be different than what's best for Millcrofton. As where Code flies, y'all aren't far apart at all, but y'all serve different communities. So it isn't going to be the same, but there's something that's going to be best for y'all and best for HPNTS. And Sarah's said it a lot. This is a best practice, but it is very much a blend of science and art. There is not one best way to do it. Not every utility needs to have 6 months of O&M. Some might need to have 12 based off their system dynamics. It might be different for the smaller communities that have one big boy in town that's 40% of your load, 40% of your volume. What happens if they shut down for a month or 2 months? Y'all probably should have more cash on hand than a system that's got good load diversity and isn't dependent on one or two large industries. Because that's something that's becoming more and more prevalent. And I'm just kind of thinking of this now. So I
Yeah.
apologize if it doesn't make any sense. But
Sure.
if it becomes more and more prevalent when bond folks that are tied to one or two, three, four industries or big companies, manufacturers in your system that are 30% of your revenue, what happens if they shut down permanently? We've seen that around Montgomery. One system had to almost double their rates over a 4-year period to dig in that, to fill in the hole because one massive clothing manufacturer left. That hurt that system for over a decade. So how can you prepare for that? Again, that's a good reason to have a little bit of extra money because you would be in that scenario. You are so dependent on one or two large customers that you really have no control over whether or not they're going to be around or not.
Yeah, that's a very good point. As we get to this next slide, I wanted to ask, I think we both meant to ask at the beginning of this, do any of y'all have specific policies, a formal policy that's board adopted? Anybody have one? Got a couple. Well, you can have a formal policy or an informal policy. And again, it's not hard to have a formal policy. And most of the examples I've seen are a page. They don't have to be long drawn out documents, and they don't have to be board adopted. You can have an informal policy. The most important part is that you know why you have what you have. So it's, as Jim was given that example, I was thinking about that. That is terribly important. We're talking about all these different kinds of reserves. You don't have to take all 7 that we listed and set a specific amount for each. It's going to be a blend of, okay, how much is going to be enough for us to cover these things? They're not all going to happen at one time, right? So you just want to make sure that you're balancing it and you understand we're going to govern around, or we're going to manage around this debt service coverage ratio, or this amount of days of operating cash, or a combination of both, or whatever your special circumstances are. Know why you have what you have.
Yeah, and we're not suggesting 7 different bank accounts.
No.
We are suggesting at least 2 because the special use, I think it was called, that is really the capacity fees, that's restricted income. Any capacity fee revenue can only go towards paying for capacity related projects, either pay as you go or in the form of debt service. So really in that scenario, you've kind of blended a little bit that your debt service coverage amount in that the one box we had up there that one box doesn't have to cover all of the debt service that you want to cover, because you can lean on your capacity fees in that special use bucket as long as the debt service is related to capacity related projects. Yes. Okay.
And really just going back over what we've said, I mean, why do you have one? What are the benefits? What are going to be the benefits? It's financial sustainability. You have to have a financial plan on what you're going to do if something unforeseen happens. It helps your credit rating immensely. For you to have a specific reason, number one, for you to have cash set aside, period. Number 2, for you to know what you have and why you have it. That is going to help your bond rating. It matters. They care how much cash you have. They care how well you're managing your system financially. And that's going to help you be more attractive and get that better bond rating. Do you want to talk to the others?
And rate stability, and for those of you that work with us, and there are a bunch of y'all in here, when we look at your forward-looking capital plan, we take that average annual need over the next 3, 4, 5 years, or whatever the best information is available, so that your rates aren't having to chase your capital plan. With proper planning, if you're spending $10 million over the next 5 years, we're going to target $2 million a year in your revenue requirement. We don't want your rates chasing capital projects. And we know that in doing that, A couple years you might under recover relative to the target because you spend 2.5 instead of 2. Some years you'll over recover, and you need to have some cash available to kind of ride that out, because you don't want to, you really do not want your rates chasing capital. You want your financial plan to dovetail with your capital plan. Those should be in lockstep year after year, really quarter after quarter, year after year. And then peace of mind, think about it from a personal level. I like having money in my bank account. I mean, that's important. That's peace of mind. If I had $5 in my bank account, I'm anxious. I don't want to have too much money in my bank account. Then I'm literally, the assets are sitting idle and not earning anything. And there are things that can be done there. But it's peace of mind rooted in the financial flexibility to take on what y'all need to take on in the most financially responsible way possible, while continuing to provide an absolutely necessary service.
And talking about resources, just wanted to reiterate that you've got a lot of resources sitting right next to you in this room. You've got the comptroller's office, GFOAA, your bond advisor is going to be more than willing to help you either write a policy or develop a policy or a management tool for that. And people like us, we want to, I mean, y'all know how passionate we are about helping utilities become financially stable and do what they need to do proactively. This is a proactive step. And again, the whole reason we decided to talk about this right now is because it is so important to so many of y'all just sitting around having conversations. And so it's important to us and it matters. And we want to see each system be financially stable and serve their community the way they want to serve their community. You want to talk through that? You want me-
Well, this is,
Okay.
on the way down here, I bought this, and this is very much a prop, but I bought it for the water in it too. And staying at the Courtyard Marriott, I paid $5 for 20 ounces of water. Not the smartest purchase I've made, admittedly, but I was really thirsty this morning. So think about what y'all are delivering for $5. It is not 20 ounces. And this, y'all have heard me on the soapbox before. A lot of times it's not simply a cost conversation, it's a value conversation. And y'all have I don't say y'all, that's a generalization and will once again get me in trouble. But your community doesn't exist without y'all, period. That is nothing to hide. Y'all are spending millions of dollars a year, and at this point, probably millions of dollars a month to operate, maintain, and improve your systems to better serve your community. Your community is your revenue stream, right? So that it goes back to the balance. How can you best serve them? The more there's some systems in Alabama that, to get technical, their rates are they're wonky. They have wonky rates. Which is Sarah's word. I almost went with Don's word, squishy, but I went with Sarah's word, wonky. And they will complain because it's too dry and they're almost at capacity. And then they'll complain and that's an operational complaint. And then it's been too wet and they're not going to hit their revenue numbers. There's got to be a better way to control that, right? And there are operational practices that can be improved and there are financial practices that can be improved, but it is, how can you best serve your community? Period. That's why all of y'all are here, right? So what can you do? And this is one of 100 different tools in your toolbox to
say that.
to better serve.
The same thing. Yep.
All right. Go ahead.
No, I mean, I was going to use the tool in the toolbox as well. This is another tool that y'all have to manage your utility the way that you want to. The typical, I will touch on this relative to the process of sort of a bullet point. Okay, if I want to do this for my utility, what do I want to do? That's define the goals. That's all those buckets we've been talking about. Assess your risk relative to what you think might potentially happen. Again, with Laura, she could never have predicted that. That is not something you could predict. And then develop a plan. It's just not hard. And then typically utilities will review kind of the philosophy of their plan about why they are putting X amount for each category. Do that every 3 to 5 years. And then annually, when you're doing your budget and when you're looking at all your numbers, review those cash reserve levels because they are going to fluctuate. That's why you want a range, not a specific dollar amount. And then figure out what you need to either build those reserves back up through your rates or other fees, and then review that so you can, we say it all the time, in order to manage it, you have to measure it. So this is another way that you can do that.
And in addition to that, with a proper cash flow projection model, you can be proactive, right? You're not having to wait until it dips below whatever thresholds there are, but you can see it coming, right? Whether it's just inflationary trends or you've got a big capital spend coming up in 2 years that you might drop below. Well, what can we do? Do we need to cut expenses? Y'all already doing that as much as you can. That's probably not a lot of juice to squeeze out of that. So maybe there's a small rate increase so that you don't dip too much below, and you're able to just kind of ride it out without having to have a more significant rate increase to pop it back up.
And that's it. Questions? Yes.
The short answer is great question, and we don't know. That's a great question. I'll find Don. Anything else?
Any other questions?
Thank y'all.
Thank y'all very much.